Candlestick charting is largely about pattern recognition. Some patterns represent stronger signals than others, and often the patterns are easy to recognize. Often, but not always. One thing to keep in mind is that patterns do not need to look 100% like the examples we'll be going through to be regarded as relevant signals. A single candlestick represents one trading period. Depending on your trading style, you may prefer the shorter or the longer view. The period can be 1 day, a week, a year, or a number of years. Daily traders prefer shorter periods, for example 10 minutes, 5 minutes, or 3 minutes. When you trade, you can use any time frame you want, but once you decide on it, you need to stick to it. Here is an example of a rookie mistake. Going into a trade based on a daily chart, but when things do not go your way, switching to the weekly chart. When you purchase the stock based on the daily chart, stick to the daily chart for all your subsequent decisions. Candlestick patterns give you the information about the probable price action in the near future. Regardless of how strong the pattern might be, you cannot rely on it to tell you what the price might look like in, for instance, 30 trading periods. Typically, the impact is only felt in the next 1 to 9 trading periods. When it comes to candlestick patterns, it can be anything from a single candle to a number of candles. The important thing to remember is that any stop trading involves risk. Candlestick charting lets you minimize that risk and go for the high probability trades, but no technique can eliminate the risk altogether. So to recap, the candlestick patterns give you the short-term information about the possible price action. You use candlestick patterns to check if the trend is likely to continue in the short term, and you use the candlestick patterns to determine if a trend reversal is likely or not. The pattern formation typically has 3 stages, and all 3 need to be considered when assessing the strength of the pattern. And the 3 stages are the lead-up stage, the trigger, and the confirmation. And here is an example. In a downtrend, these 3 candles are formed in the lead-up stage. Then we have the trigger. In this example is the single candle called the hammer, which is often found at the end of a downtrend. It has a small body and a long shadow. Finally, the next 2 candles constitute the confirmation. They indicate that the trend has indeed reversed the direction. In the next video, I will be talking about 5 important aspects of a candle. See you in the next video. This is Dr. Alex Davidovich, and thank you for watching.